So, this class basically is for Forex beginner topic. We want to talk about things you will need to know as beginners. We want to talk about things you will need to know as beginners. Okay, so guys, if you can see my screen, you just let me know. Can you see my screen? Can you see my screen?
Yes.
You can see my trading view, right? Okay, so don't worry, the video will be on YouTube very soon, this particular one. So if you can see my screen, let's start. So what is Forex trading? Forex trading is the simultaneous buying of one currency against another. As we have it here, Forex trading is the simultaneous buying of one currency against another. So I will explain to us what that basically means. I will explain to us what it basically means. Okay. Alright. So Forex trading is popularly known as FX. The full meaning of the word is foreign exchange market. So it is the simultaneous buying of one currency against another. What that means is that whenever you are trading, you are buying one currency against another. Now, the reason why I want you guys to see my chart is so that I can explain it to you using these candlesticks you see here. Now, you can see that most of this candlestick has two colors, right? Can you guys hear me? If you can hear me,
We are not seeing candlesticks.
just say you can hear me. Okay, so what can you see?
Continuous loop of your picture and those listening to it.
Okay. Share screen. Okay. Can you see it now?
No. Yes.
You can see trading view now, right?
Yes.
Okay. So I say it is the simultaneous buying and selling of currencies. Now the reason why I want you to see trading view is not as if I want to show you guys something unique. I just want you to understand it from this perspective so that when you guys are looking at the chart, you guys will know what you are looking at. You can see that we have two colors of candlestick here, right? Can you guys hear me?
Yes, sir.
Can you hear me? Okay. We have two colors of candlestick here. We have red colors and we have blue colors. Now, these blue colors, they represent one of these currencies. Hope you guys can understand me. Can you guys hear
Yes.
me? Okay. I would like you to always comment. I would like you to always comment. Okay. Is this what you are still seeing now? Okay. So what I said is, you see this candlestick? We have this blue one, we have the red one. Now, the red one represents one of these currencies here, and the blue one represents the other currency. Do you understand? So I told you forex trading is being traded in pairs. Forex trading is being traded in pairs. Yeah, so you cannot trade one currency like this. This GBP here stands for Great British Pound, while the JPY stands for Japanese Yen. So you cannot trade one currency. You can't. You have to have them like this. This is a currency pair. What you are doing is that you are buying and selling one currency against another. Now, this currency, there is a part of the first one here you see is called a base currency, while this second one is called a quote currency. Now that is how it happens to all currency pair. Let's see what I'm talking about. We have okay, let's wait for this to load. We have Euro USD, we have GBP JPY. Yes, this is Euro USD. So for in this currency pair, the euro is your base, the US dollar is your quote. This is British pound, US dollar. GBP is your base, US dollar is your quote. Now the idea is that for every currency pair, the first currency is the base currency. The first currency is the base currency, while the second currency is the quote currency. So this is the base and this is the quote. Guys, hope you guys are understanding me.
Yes, boss.
All right. Now I know most of you know these things already, but I just want you to see it live from here. I want to explain it from this chart angle so that you can understand it properly. Now that you know that, now one thing you need to know again is that currencies in forex are being traded in pairs. This means they are traded foreign exchange, blah 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 blah. Currency pairs are generally categorized into three main groups: base currency and quote currency. Okay, this one is something else. But hope you guys understand this base currency and quote currency now. Can you guys hear me? Okay, but I'll still explain it better later. So now that we know that, I promise you guys this class will be very quick. I'm going to at least 11:30 we are done because we know we start. It's supposed to be 11 o'clock. Now that we know that, the next thing I want you guys to know is that there are three categories of currency pairs. We have the major currency pairs, we have the minor currency pairs, we also have the exotic currency pairs. The major currency pairs, these are the most actively traded currency pairs involving the US dollars. Now there are 7 major currency pairs. The reason why they are called major currency pairs is because they are actively traded. They are active, so it means people's attention are majorly fixed on those pairs. So they are actively traded. Now there are 7 major currency pairs. We have the US dollar, we have the euro, we have the Japanese yen, we have the Great British Pounds, we have the Canadian dollar, we have the Australian dollar. So they are listed as euro, USD, Japanese yen, British pounds, Canadian dollar, Australian dollar, and there is one I'm missing. Canadian dollar, Australian dollar, Swiss francs, Japanese yen, euro, USD, 1, 2, 3, 4, 5, 6, 7. Okay, we have the US dollar, we have euro, we have Japanese yen, we have the Great British Pounds, we have the Swiss francs, we have the Australian dollar, and we have the Canadian dollar. We have the Canadian dollar. So these are the 7 major currency pairs. So what it means by 7 major currency pairs is that they are actively traded. They are actively traded against the US dollar. So now, if you look at my screen, you see that we have GBP, JPY. So, and the two of them are major pairs, right? Can you guys hear me? Can you guys hear me? Guys, can you hear me? Okay. Okay. Now, the two of them here, they are called major currency pairs. But the reason why I will not classify this, or the reason why they are not classified as major currency pair, is because they don't have dollar with them. This is what I mean. This is what I mean. They don't have dollar with them. This is a major currency pair. The euro dollar. This is a minor currency pair because dollar is not here. Although GBP is a major currency, JPY is a major currency, but none of them is being traded against the dollar. So this one right here is a major currency pair because you have US dollar against JPY. But GBP against JPY is not a major currency pair. It's a minor currency pair. It's a minor currency pair. Then NZD against US dollar is not a major currency pair. Neither is it a minor currency pair. It is called exotic currency pair. You understand? Now, let's see the definition of the other two. Minor pairs. These pairs consist of two major currencies, excluding the US dollar. Examples include Euro JPY, GBP JPY, like what we have here. Not this. Euro JPY. This is a minor currency pair. This is a minor currency pair. GBP JPY, AUD JPY, Euro GBP. All these are minor currency pairs. But you see USD CAD is a major currency pair. You see USD CHF is a major currency pair. So currency major pairs that are being traded with the US dollar or against the US dollar is known as major currency pairs. While major pairs that are being traded against each other excluding US dollar is known as minor currency pair. While exotic currency pairs, these pairs involve the US dollar or another major currency against the currency of a smaller or emerging economy. A smaller or emerging economy. Let me see if I'll see anyone here. Okay, let me search for it. NXN USD. Okay, let's see something. Let's see how this pair look like. Okay, now you see this currency pair. This currency pair is an exotic currency pair. It's an exotic currency pair. Now, what's the disadvantage of this pair? These pairs generally have the lowest liquidity and wider spreads of the three and can be more volatile due to factors specific to the smaller economy. So these pairs, they have wider spread. That brings us to the next topic. What is spread? What is spread? Spread is the distance between your bid and your ask price. Spread is the distance between your bid and your ask price. Now, what is your bid price? Your bid price is actually the price in which the market is buying from you, while your ask price is the price in which you are buying from the market. I think that's it. Okay, let's see it from here. See, in the financial market, the ask and bid price represent the best price at which a buyer, which is a bidder, and a seller, which is the asker, are willing to trade an asset at a given time. They represent the two sides of a transaction. Okay, ask price this is the lowest price a seller is willing to accept for an asset. Then is bid price. This is the highest price a buyer is willing to pay. So what it means is, take for example, you want to sell something for me, and you want to sell that thing at, let me say, 20,000 naira. That 20,000 naira you are saying is the ask price. Is the ask price. Is the price at which the seller is willing to accept. So now, if me, I'm saying I want to buy that thing from you, and I have maybe 15,000, that's the bid price. That's the bid price. Now, the ask price is the price you, the seller, want to sell. The bid price is the price me, the buyer, want to buy with. Now, the spread is actually the difference between that money you want to sell from and the money me I'm willing to pay. So, if you are selling for 20,000 and I'm willing to pay just 15,000, 5,000 naira is the spread. Do you understand? Are you guys with me?
Yes, sir.
Okay. Now what I'm saying is, let's say I want to say you want to sell something. You want to sell maybe a pair of shoe. You want to sell a pair of shoe for 40,000 naira, for example. And me, I'm willing to pay 35,000. That price at which you want to sell from is called the ask price. It's called the ask price. That price you want to sell for, ask price. While the price at which me I'm willing to buy, the price at which me I'm willing to buy, 35,000. That's the bid. That's the bid price. That's the bid price. That the price me I'm willing to buy from. That price is what we call the bid price. That particular price is what we call the bid price. And that bid price is now the difference between the ask, that is the money you want to sell for, and the money me I'm ready to buy with, is what we call spread. Do you understand?
Yes.
Okay. Now the difference between the money you want to sell and the money I want to buy is what we call spread. So the spread at that point is 5,000 naira. So what we are learning from here is that the reason why that exotic pairs are not advisable, I won't advise you as a beginner to trade it, is because they have wider spread. So the money the market is willing to sell to you and the money you are willing to buy from, they are different. And if you are selling, the money you want to sell and the money the market is willing to buy from, they are different. So the spread will be big. And one disadvantage of spread is that spread can take you off the market before the market starts going your direction. It's not as if price literally hit your stop loss. So stop loss actually is where if the trade is going against you, it's going to your stop loss. So it's not as if the market literally hits your stop loss, but spread got there before price. So if the spread is wide, it can affect your trading. So this is why it is advisable not to trade that pair as beginners. As beginners, the recommended pair, that's the pairs I will recommend for you as beginner, are major pairs. And under major pairs, I will recommend the euro dollar, the GBP dollar, and maybe USD card, any of these major pair traded against dollar. You understand? Because they have a tighter spread. The spread is very tight. So if you are trading that currency pair, you are not afraid of spread. No matter the broker you are using, you are not afraid of spread. So that's the advantage. That's for that. Alright, so quickly let's talk about something else before we call it in it. Before we call it in it, let's quickly see something else. Right. Now back to the chart. Back, back, back to the chart. Okay. No, no. Back to the chart. Guys, can you see my screen?
Yes.
Okay, you can see my trading view, right?
Yes, sir.
Alright, so now I was saying something about this candlestick. So you see, this we changed currency, we changed the currency from that GBP whatever to this one now. Now this is the Mexican pesos against the US dollar. And what we have here is actually the same. These blue candles represent this MXN, while the red candles represent the US dollar. So now, this is what basically happens whenever we are trading. Let's say I maybe have analyzed this market and I'm taking a buy from here, from this particular point, targeting maybe this point and putting my stop loss here. You see, this particular red portion is actually my stop loss. So what this means, this pattern I drew here, what it means is that the moment the price gets to this middle line here, I'm in for the trade. And as soon as the trade is going against me, the moment it gets to this point, I'm out with whatever I'm losing. Now, if it's going for me, the moment it gets to this point, I'm also out with whatever profit I've made. You understand? So that's it. Now, this particular trade I just did for you now, I just draw it here now. What it means now is that this Mexican pesos actually was moving up. You understand? It was moving up. That's why we have these candlesticks going up. So the bullish candlestick is basically for the base currency, while the bearish candlestick is for the quote currency. Whenever you see the market going up, you know the first currency between your currency pair is what's pushing up. And if the market is going down, you know the second one is what's getting the power. So let me use this term. This currency pair right now, we have this guy MXN as the bullish and US dollar as the bearish, right? So if you are selling against the market, maybe you are taking a sell from here, targeting this point, and your entry here, your stop loss is maybe here like this. What you are doing now is that you are anticipating that US dollar should come down, and the moment it's coming down, you are making money. But now let's say you have something like this. You can see if you check this pattern, you discover that the market hits your stop loss. So this one is a losing trade. You lost your money. You understand? Are you guys getting it? Are you guys understanding me?
Yes.
Okay. Alright. So this is basically what's happening whenever you are trading. So that's it. I just want you guys to know that the candlestick you see in your chart is actually a representation of the currency pair. It's actually a representation of what the buying and selling is of the buying and selling that is happening within that currency pair. Of the buying and selling that is happening within that currency pair. So I just want you guys to understand that basically this night. So that whenever you look at the chart, what you are supposed to see is that the buyers and the sellers are moving. This red candle signifies bearish candle, which is speaking for this JPY. Then this blue candle signifies bullish candle, which is speaking for the GBP. So right now, if you have the market going up, you have a bullish market. If you have it coming down, you have a bearish market. What it means is if the market is coming down, GBP is in power, is in control. If the market is going up, JPY is in control. Do you guys get that? So that's the logic. That's the first simple basic knowledge I think you guys need to have about Forex trading. It's being traded in pairs. We have the base currency, we have the quote currency, and the base currency is actually the first among the two, no matter the pair you are trading. So that's it. That's it for that. That's all we'll be talking about today. Our next class will be on Monday, and on Monday we'll continue from here. So what I want you guys to do for me now as your assignment, go and do a research on base currencies, quote currencies, and exotic currencies. I want you guys to drop it on the group before the end of tomorrow. You also drop it on the group. And for those of you who are much advanced than what I'm teaching now, your own assignment, because I remember some of you here attended the market structure class where I talked about bullish and bearish. I talked about uptrend and downtrend. Although we are not done with that class yet, and I think that's what we'll be doing on Monday. So every Monday I want to be dedicating it to the intermediate students here. Then what's today? Today is Thursday. Every Thursday will be for the beginners. So that's what I'll be doing. So on Monday class, I'll continue from market structure. But before Monday, I want you guys to do me a favor. Those of you that you are good enough for it. You attended my market structure class. I want you guys to go to the chart, map out a downtrend, map out all the break of structure till you meet a change of character, also known as market structure shift. So let me just quickly do a little recap on what I'm saying. This particular trend now is a downtrend. So if you want to mark it out, you look for the place where the uptrend ended and the downtrend started. Okay, like this particular one now, and this is an uptrend, but top here we have failure swing. So I can't classify this as a trend, but here we have a change of character. Then we have a break of structure here. Then we have another break of structure here. Then we have this as change of character. Let me just, so you can see how I just map this one out right now. So that's what I want you guys to go and do. Go to your chart, go and map out the break of structures on your bearish market, then change of character to the bullish market, then continue the break of structure. If I were you know what I would do? I will go to my YouTube channel. I just dropped a video there that can help you solve this out. I explain market structure again on that video with break of structure. I did it this evening. I dropped it there this evening. So you can visit it and just check out the video so that you know how to do it properly. I want you guys to submit this assignment to me privately on my WhatsApp, and I want you to submit it latest on Sunday evening. If you fail to submit it on Sunday, don't submit it on Monday. It just means you failed the class. So that will be all for tonight, guys. See you on Monday, and make sure you do my assignment. Hope you are clear. Any question? Doctor, do you have any question?
Yes, sir. Just explain that spread again.
Okay, I should explain the spread again.
Yes,
All right. Now, you remember what I said? Like, take for example, you want to sell a pair of shoe. Yeah. Now that pair of shoe, you want to sell it for 40,000 naira. That's the ask price. That's the price the seller is willing to sell at. So that's your 40,000 naira is the ask price. Then, but me that want to buy it, I want to buy it for 35,000. So that 35,000 I want to buy from is the bid price. You understand?
Yes, sir.
Doctor, okay. So that 35,000 I want to sell from, I want to buy with, that's the bid price. But that 40,000 you want to sell at is the ask price. Now, the spread is actually the 5,000 in the middle. That is the spread. That 5,000 you are not willing to let go. That 5,000 I'm not willing to let go. That's the spread. Now, in a normal market setting, let's use normal market. If you want to sell something for 40,000 and I want to buy it for maybe, let me say, 10,000, how will you feel? Like, just reply me like you want to really sell something now. You want to sell something for 40,000, but me, I'm telling you I want to buy it for 10,000. What? Just tell me something you will say to that kind of person. Just tell me one.
You want to chase me with your price now?
Do you see? Because why? The spread is too big. How can you reduce 40,000 naira to 10,000? That's you understand me? The spread is too much. So because the spread is too much, you don't want to buy it. That's why you don't want to trade those exotic pairs, because their spread is very wide. Their spread is very wide. You understand? Their spread is very wide. So that's why you don't want to trade them. Because if you are selling for 40,000 and buying for 10,000, 30,000 naira is our spread there. Because that's the difference between the price you want to sell at and the price at which me I'm willing to buy. You understand?
Yes, sir.
So that 30,000 naira is the spread. And because it's so big, you don't want to do that kind of business. So that's why you don't want to trade those pairs. Their spread are very big. But if you are selling for 40,000, if you are selling for 40,000 and I'm buying for maybe 38,000, you can sell for that kind of person now. Just 2,000 naira you can sell. So because the spread is not big. So that's how it plays out here on Forex too. Forex too. You don't want to trade when the spread is big. You want to trade when the spread is acceptable. That's why it's advisable. Trade the euro dollar, or you trade any other major currency pair against dollar. Minor currency pairs are good, but as a beginner, I will advise you to just stick with major currency pairs like euro dollar, GBP USD, CAD USD, JPY USD, CHF USD, whatever USD, just trade it. But don't trade anything outside the major currency pair. Do you understand now?
Yes, sir.
Doctor, do you understand? All right. So any other question?
No, sir.
Uh, Promise, do you have any question? Daniel, do you have any question?
No.
All right. Okay, so if there's no question, then I think we can round off from this session now. Now, the reason why I did this class was basically for the newbies, but most of them told me they later called and told me their phone, their network is bad. So what I'll do is to upload this video on YouTube so that they watch the video. For most of us here, I know we are more advanced than this because you have been with me for some time. But it's better you do it like a refresher course so that you can refresh your mind again. So that you can refresh your mind. Now, your assignment for those of you who are advanced, you know you are advanced than this, you don't already know this basic. So your assignment would be for you to go to your chart and map out break of structures and send them to me. I explain it on that market structure class. If you still don't know it, go to my YouTube channel. There's a video I just uploaded this night. You watch the video. It's strictly on market structure. Watch the video, follow it as I did it on that video, and the outcome will be profitable. The outcome will be good. So, all right, guys. See you guys in our next class. And please don't forget we have our next class on Monday by 10 p.m. as well. You can invite your friends. The class is free. You can invite your people, tell them to join. Let's grow together. Let's learn together. All right, guys. Good night.
No, sir.
All right.